In this video, we'll discuss the cardinal rule of selling, the one rule that will protect you from big losses in any market. Here it is. If a stock falls 7% to 8% below what you paid for it, sell. No questions asked. You don't have to look at a chart, and you don't have to see how the overall market is doing. Just sell immediately to protect yourself from a potentially larger loss. Here's just one example of why this rule is so important and effective. When the financial crisis hit in 2007, too many people just watched as their stocks fell 10, 20, even 50% or more. That's absolutely tragic because there's no reason to suffer big losses like that. Think how much better off you'll be and how much better you'll sleep at night if you just follow this one simple rule and cut all your losses at no more than 7 to 8%. Think of it like stock market insurance, a simple way to always protect yourself from potential harm. Now you may be asking yourself, why 7 to 8%? There are two reasons. First, if you buy a stock at a proper buy point, history shows the stock will not usually drop more than 8% below that price. If it does, that means something's wrong and you should sell to protect yourself. Here's an example of a stock that came out of a buy point, then headed south. Let's say you bought Applied Films on January 5th, 2004 as it broke out of a base. The buy point was $34.64. It rallied for a couple of weeks, but then it sold off hard. It triggered the 8% rule when it dropped to $31.86. At that point, you should have automatically sold. Now, right after that, the stock bounced back and rallied again. There's no denying it. It's frustrating when a stock goes up right after you sell. But again, think of this rule as insurance. If your house doesn't burn down by the end of the year, do you get upset that you just paid a whole year of fire insurance? Of course not. That insurance protects you from potential disaster, and the 7 to 8% sell rule does the same. Now look what happened next. The stock took a huge dive. Let's say you didn't sell when the stock originally dropped 8% below your purchase price. You might have been thinking, see, I don't need to follow that rule every time. But IBD's rules are there for a reason. They help you take the guesswork and emotions out of investing, and they always keep the odds of success in your favor. If you didn't sell the first time the stock dropped 8% below your purchase price because you thought it's a great stock, you'd be that much more likely to hold when it drops again. And that's when investors get into big trouble. You start rationalizing as the stock declines and soon find yourself sitting on a huge loss. Now it's important to be honest with yourself. If you tend to let emotions get in the way when your stocks are dropping, and that happens to a lot of people since we're all human, then you need to set up ways to ensure that you don't let that happen. One way is to set up a stop-loss order so that your stock is automatically sold if it drops 7 to 8% below your purchase price. Your brokerage service can show you how to set that up. Note that this rule applies to your purchase price. If you buy a stock at $100 and it drops to $92, then you sell. But if you buy it $100 and it goes up to $150, then pulls back to $138, that does not trigger this rule. This chart shows you the second reason you should cut losses at no more than 7 to 8%. If you do, you only need to gain about the same 7 to 8 or 9% to get back to even. But if you hesitate and you let small losses become big losses, you'll have a deep hole to climb out of. For example, if you lose 50% on a stock, you have to get 100% gain just to break even. And how many stocks do you have that double in price? Not that many. If you follow this rule, then you can lose money on 2 or 3 trades and still break even or come out a little ahead if you have just one stock that goes up 20 to 25%. Two final notes. 7 to 8% is the maximum amount you should ever lose. You can always sell sooner if your stock or the overall market isn't acting right. Also, remember that the goal of investing is not to make money on every trade. The goal is to make big money when you're right and only lose a little when you're wrong. If you follow this cardinal rule of selling, you'll be positioned to make big profits over time by hitting a lot of singles, a few doubles, and the occasional home run.